What we are seeing at Allfunds is as the fintech banks extend even more into wealth, the pace of growth is exponential. And in particular, I must say, some of the things we're seeing in Asia are now extending to the rest of the world. That pace is phenomenal. We're in a generational change. When assets pass between generations, they tend to become financial versus physical. And you can really see it in the Middle East. Less local real estate, more global exposure. I do believe incumbent firms can get AI right and solve their legacy issues, map their code, understand their interdependencies, modularize their IT architecture, reset their core systems, and be more agile. And we're starting to see the separation from those who use it and those who don't. It's not just an efficiency game, it's a client focus game.
Hello and a warm welcome to Money Majlis, your favorite business podcast streaming from Dubai. I'm Suvo Sarkar, and on this show, we explore how money really moves around the world, not just in markets and portfolios, but through the pipes, platforms, and policies that sit behind the global wealth machine. Today, we are going deep into the plumbing of modern wealth, the infrastructure that quietly connects asset managers, distributors, and end investors across continents. The infrastructure that is now being rebuilt at extraordinary speed. Here's the scale of what we are talking about. There are now well over $100 trillion of investable wealth sloshing around the world, and a surprisingly large share of it flows through a small number of platforms most people have never heard of. One of these platforms processes more than $2 trillion in assets. And if I told you the company behind it has fewer than 1,300 employees, you would start to understand just how much leverage technology has in this industry. My guest today, Annabel Spring, sits right at that intersection of global wealth, large-scale banking, and platform innovation. She runs one of the biggest business-to-business wealth tech ecosystems on earth. But she's also led one of the world's major private banking and wealth franchises inside a global bank and run an integrated wealth business in Australia. That rare combination of operator and platform builder is exactly what we look for in Money Majlis. But first, a message from my sponsors.
Fab Business Banking presents Money Majlis, a podcast shaping conversations on banking, finance, technology, and marketing. Visit bankfab.com to learn more.
Money Majlis is brought to you by Saxo Bank, the trusted European bank helping you make better investment decisions.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Aquanow, the premier crypto-as-a-service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
Money Majlis is proudly sponsored by WealthBricks Capital Partners Limited, the trusted, independent, and expert wealth management firm.
My guest today is Annabel Spring, Chief Executive Officer of Allfunds. Allfunds is the world's largest business-to-business wealth tech platform, the connective tissue between fund houses and the firms that sell their funds. It links more than 3,300 fund groups and asset managers to over 900 distributors, banks, private banks, and wealth managers across 66 countries with close to 1.8 trillion euros in assets under administration running across the platform. It operates 17 offices on 4 continents, including one right here in Dubai. Annabel took the helm in June 2025, just over a year back, after a career of over 25 years spanning 4 continents. She joined from HSBC, where she was most recently CEO of Global Private Banking and Wealth, running a business at the heart of HSBC's strategy in Asia and the Middle East. Before that, she spent nearly a decade at Commonwealth Bank of Australia, where she was Group Executive for Wealth Management. She began her career at Morgan Stanley in investment banking and then as global head of firm strategy and execution. Annabel has taken the job at a genuinely pivotal moment because Allfunds itself is in the middle of one of the biggest deals its industry has seen in years. But we'll come to that. Annabel, welcome to Money Majlis. It's great to have you on the show. I've been wanting to do this episode for a while because on this show, we talk endlessly about the visible face of wealth and almost never about the infrastructure underneath it. And your vantage point, having sat on both sides of the line, is genuinely rare. Annabel, congratulations on Spain's victory in the FIFA World Cup last night. That was an amazing game.
Thanks so much. Everybody is so excited. I was sitting on the roof of my building watching the city breathe, waiting and waiting. Such an exciting game. The streets are full of red and yellow. But thanks so much. It's a delight to be here.
Thank you for joining me. I know we've got a busy schedule, Annabel. Let me start at 30,000 feet. Over the last decade, global wealth has climbed past $100 trillion. The product shelf has exploded from ultra-cheap passive funds to complex private market vehicles, and regulation has tightened almost everywhere. From where you sit, what has actually changed structurally in how wealth is distributed? When you compare, for example, how products are manufactured, distributed and serviced today versus, let's say, 10 years ago, what is genuinely different, and what do you think is digital lipstick on a same old monkey?
So Suvo, you're so right. The growth has been tremendous, and we really do expect that to continue. Those structural themes remain the same. But I think one of the big accelerants is actually digital. So the macro themes, growing economies, aging populations with higher propensity to save than to draw down, geographically, the rise of newer wealth hubs, Asia, LATAM, and certainly the Middle East. We see all of that in the flows at Allfunds. So what is different, including digital? I think it's three core aspects that you highlighted. First of all, the customer is different. As a consequence of digitization, they're more engaged, they're more informed, they're more connected, plus they're wealthier, and they have much greater expectations of a digital experience. Information makes a huge difference, candidly, to FOMO, right? And we've all seen it. Look at the scramble after SpaceX. That was driven by much greater access to information and access to distribution than previously. And that brings more money into the market. But I guess that brings us to our second theme. Distribution's different. Broader access, faster access, information and choice with accelerated delivery, often customized by AI. That ability to do mass customization, mass prompting, fundamentally changes the customer experience and drives engagement and participation. Look, we all have apps on our phone, right? We all play on them. We all read them. We expect to do whatever we want, whenever we want. And what we are seeing at Allfunds is as the fintech banks extend even more into wealth, the pace of growth is exponential. And in particular, I must say, some of the things we're seeing in Asia are now extending to the rest of the world. That pace is phenomenal. And finally, the product's different. Almost all markets have moved beyond the home market bias, and they now offer global exposure. That's local and global product, which is adding value to end investors via diversification. Digitalization's driven the acceleration of ETFs, of mutual funds, simply by making them easier to use. Robo-advice is cheaper and more accessible. Now, just one important nuance that most commentators miss that brings together all of these themes. We're in a generational change. When assets pass between generations, they tend to become financial versus physical. And you can really see it in the Middle East. Less local real estate, more global exposure. As a private banker, I used to have meetings, and one of my favorite meetings was the father was in local real estate in a big way, but the son was in private markets and crypto. So we're seeing increased financialization of wealth into investment products due to generational change, accelerated by technology.
You are so right, Annabel, about generational change. I see it every day. But my own view, Annabel, is that the old linear manufacturer to distributor to client chain is dissolving into something more like a network. Platforms, data pipes, and service layers all kind of plug into each other. Do you still find that linear model useful, like in the old days? Or do you generally think in terms of ecosystems now? And if it is an ecosystem, who actually sits at the center? The advisor, the bank, the asset manager, or the platform?
Shiva, that's a great question. I agree with you. It's an ecosystem. However, I believe the end client absolutely must be the center of everything we do. Not the platform, not the asset manager, not the bank, the insurance company, or the fintech. Everything needs to radiate from the customer in concentric circles of ecosystems, which connect like a web to make everything work for them. And everything we do is a means to that end. The platform isn't the center of the ecosystem. It's the connective tissue that lets everyone be closer to the client and meet more of their needs better. For Allfunds, that's the opportunity to scale, centered around the needs of that customer. So what does that look like? Distributors are expected by their customers to have broader product shelves, seamless connectivity, scalable architecture, and of course, cost-efficient operating models. We provide that. Asset managers need to distribute effectively globally to multiple distributors, cost-effectively and seamlessly. Allfunds provides that. And with the market moving the way it is, fast-moving, complicated products, mutual funds to ETFs to all flavors of alts, that level of operational complexity is rising, the pace of transformation is accelerating, reinforces the value of a platform like Allfunds, but importantly, that customers.
Got it. Annabel, you run a platform connecting thousands of fund groups to, let's say, hundreds of distributors across dozens of countries. You also run an integrated wealth business inside a universal bank. Having seen both worlds, where do the biggest frictions still sit in the system? Is it onboarding and due diligence? Is it data and reporting? Is it cross-border complexity? Or simply legacy technology that can't talk to anything new? Where are the frictions?
Wow, that's some familiar themes from my life over the last 15 years. Mm-hmm. My most realistic view, our world is just complex. And while some of the mechanical complications can be solved with technology, not all of them can. The good news is issues like data, reporting, some aspects of tax, and importantly, legacy tech, which are complicated but not complex, are getting solved. Still too slowly, but they are getting solved globally with tech, better processes, and always a bit of AI, while recognizing there's a cost of customization, both in terms of spaghetti and just the sheer cost of implementation and updating. So this is a lot of work for lots of players, but the winners, and we are seeing some winners, they are moving fast to do that. However, I think as wealth practitioners, there's a lot of wealth that's complex and needs judgment. And there's friction that needs to be analyzed, but then really, really carefully judged. Cross-border interpretations, investor classifications, one that's near and dear to all of our hearts, managing KYC and AML judgments. Mm-hmm. We can make them faster and better with technology, but we need judgment. Most importantly at all, and I think this is good news for the wealth management industry generally, relationships with clients can be made more efficient with technology. They can be made more customized, but a little human friction in the form of a relationship really adds value to the client. So as an industry, we won't be able to make it seamless or completely frictionless, but maybe we shouldn't because there's value in the complexity.
So that brings me to a tension that I want to talk about, Annabel, which is scale versus differentiation. Platforms like Allfunds exist to deliver industrial scale efficiency. Yet every private bank and wealth manager on the earth insists it wants a differentiated proposition. Is the industry honest with itself about how much of the value chain it should own versus rent? And when a client of yours sits across from you, how do you help them draw that line?
That's such a good question. Our role is to support our customers' ambitions. We aim them to allow them to be unlimited in their choice. They choose the market, the segment, the distribution model, the asset allocation, the products they want to use in support of that, and the structures the client needs. We deliver whatever they choose that their clients need. I think of us and the infrastructure as the wheel. Don't reinvent the wheel. You design the care for the customer that you're targeting. You can be, delivering a Ferrari or a Golf. That's entirely up to you. So looking through that, the distributor should do what's important for them to do, which is understand their client and deliver to their specific needs. I always think at the distributor, there's two key people. The CIO, asset allocation and product choice is their role. But underneath that, I believe that macro level open architecture for product is essential. I am yet to see a distribution firm that absolutely manufactures the best asset management product for all segments and all asset classes, hence the need for open architecture. That's where we come in. But the second person is also important, and that's the CTO, to deliver the product and the solutions in the way that the client wants. Do they want robo, or do they want a high service private bank that's looking after multifamily office, delegated reporting, etc.? Whatever they want to consume, we deliver at scale. That's what open architecture is about. But you asked me a second question that's super important. Where do we draw the line? We're a B2B player. We're not B2C. We don't compete with our distribution clients. We're also not a fund manager. We don't create product to compete with our fund management partners. We can offer model portfolios suggested by third parties, and many people choose to use them, but we don't pick and choose. We believe that distributors should know their clients' needs best, and fund managers, it's their role to deliver investment performance.
So let's make it concrete, Annabel. When a major bank decides to build on Allfunds today on your platform, what are the top 2 or 3 capabilities they are looking for that simply weren't on the agenda a decade ago? Is it analytics? Is it APIs to their digital channels? Is it access to private markets and alternatives? What's generally new in that ask that you're seeing now?
The ask used to be simple. It was make it easy for me to distribute. But now that's make it easy for me to distribute everything, everywhere, all at once. So tangibly, what does that mean? You're right. It's a wider range of products, mutual funds, ETFs, alts. We have 188,000 ISINs of all forms, every structure, every flavor, LTIFs, LTAFs, UCITS Part 2, et cetera, et cetera. The second thing it means is truly global access. More and more distributors are consolidating their platforms around the world, and they want a global partner. Global distributors is trying to use the same technology wherever possible, and that's that whole ecosystem. We have a growing number of distribution partners who are with us in 5 or more jurisdictions. The third thing, though, is local needs are critical, and they're evolving. Specific needs. So the insurance network in the Nordics needs some specific tweaks. T+0 in Hong Kong, specific Manco needs in the UAE, which everyone would be familiar with. No one size fits all. And that's where our global expertise, deep local knowledge comes in. But beyond those 3, you're right. There's increasing expectation. Digital connectivity, analytics, data, and speed. Clients expect seamless API integration into their own channels, real-time processing and information. 5-10 years ago, those capabilities, I think they were differentiators. Now they're table stakes. Looking forward, I think we'll see innovation continuing to change client expectations. Tokenization, AI-driven insights, new ways of delivering investment solutions, and probably advances, and hopefully, I guess, advances in private market distribution.
Let's go to private markets, because this is where I believe the hype and the infrastructure reality collide. A decade ago, I would say private equity and private credit were the preserve of institutions and the ultra-rich. Now, every private bank pitch has a private market slide and a promise to democratize access, right? From where you sit, what's really driving this surge? Is it structural shift in where the returns are generated, a hunt for yield, or a product innovation looking for a story to tell? What is driving this surge towards private markets?
Having grown up in investment banking and capital markets, where we were taking companies public and doing formal documentation for debt, etc., it is structural. Companies are staying private so much longer. Wealth clients who are locked out of venture capital or locked out of private equity get locked out of that growth, full stop. So without retail private markets, that growth and those profits and those values really accrue only to the institutions. Now, even while it's structural, investors need to be paid for the illiquidity. So of course, you're right. It's a hunt for excess returns and for high yield on the private credit side. But also, from when I was talking to end clients, I would also add diversification. Access to different assets, different stages, PE, private credit, but even more so real estate and infrastructure and multi-strategy hedge funds. Diversification adds the ability to leverage as well, which adds returns to the individual customer level, which is really important. And we see that a lot in terms of that access across the Middle East. Now, of all people, I know that 10 years ago, it was hard to get Middle Eastern clients to consider diversifying away from local businesses and local real estate. But now in the Middle East, we've seen that move to private credit, and it ties nicely to the region's desire for steady cash flow and then into infrastructure to look for those long-term secular trends, which I think the Middle Eastern market in particular really understands from its own growth over the last 20 years. And hedge funds are coming into play here now as end investors to navigate what we've all seen recently, market volatility, and we need the need to preserve capital. And we see a really good liquid alts play. And we're seeing all of that through our flows. So structural, yes. Yield, yes. Diversification, yes. We should also remember, though, the asset managers are looking for new demand globally. And that's clearly been a massive driver of the growth because they're investing a lot in education and in distribution.
Now, Allfunds has been pushing hard here, right? Your alternatives business has been one of the fastest growing parts of the platform. Your assets under distribution in alternatives jumped, I believe, about 68% year on year. And you now have well over 200 alternative fund partners on the platform. You even launched a tokenized private market share class with firms like Hamilton Lane. So you've got real skin in the game. But I want to push you. Are the suitability and understanding frameworks keeping pace with the distribution ambition for these kind of funds? Where is the biggest gap between what the marketing promises and what a typical wealth client actually understands about private markets?
That's such an important question and one that more and more people are talking about now. And I think diving into that in detail is really worthwhile. You're right. We have US $100 billion on the platform now. And the gap used to be access. People were so keen just to get in. These were institutional and family office products and seen as really something that was exclusive. Now access is achievable and the distribution of the products has widened. It's been facilitated through infrastructure, through platforms like Allfunds. But the biggest gap to alternatives going mainstream, it's not access, it's education, and it's managing the complexity of the product through the infrastructure and the innovation. Now, you can imagine after so many years in wealth and private banking, I see this almost entirely through the lens of the end investor. So let's just put ourselves in the shoes of the individual for a second. Let's talk about what does an individual need to understand. The first thing is the features of the products itself. Risk, return, diversification, benefit, liquidity characteristics. Private markets shouldn't be expected to behave like public market investments. Now, as an individual investor, that means if you buy an illiquid product in a difficult space, let's say software right now, you won't be able to sell anytime you wish. You might be able to get 5% out every quarter. So getting out is going to be slower than your reactions to the market might be. And that pace asymmetry is hard for investors who've been used to pivoting faster. Really tricky and always something for individuals to think about. The second thing that we don't talk about enough is retail investors understanding themselves and their liquidity needs. I'm pragmatic. If you're going to need this money for college fees, buying a house, please don't put that money in a private asset that has a liquidity threshold. If you're going to need the money quickly, these products are not for you. So there's a limit as to how far private markets should go. And also for some really personal things, and I'm speaking now as a former private banker, if there is any chance of the big 3 Ds, death, divorce, or disaster, please think carefully. If you're going to need the cash, you're heading into some personal complexity, you need to stare into that risk-return liquidity trade-off and really think about it. So I think we talk about the features of the product, but we don't talk about how your views might change as an investor, and we don't talk about how your circumstances might change as an investor. And they are critical questions.
No, Annabel, you're so right. These private market alternatives are often illiquid, opaque, and sometimes highly leveraged strategies, frankly. I mean, you've carried both the P&L and the reputational risk of large wealth franchises. So when you think about making private markets a genuine mainstream allocation, not just a niche sleeve, what absolutely has to be in place underneath? Is it better fund governance, standardized data? What's the part of the plumbing most people underestimate?
All of the above. We've talked about education, but what really must come is visibility in the systems of the wealth manager and reporting to the client. The end client needs to be able to see and analyze the product as part of their portfolio. And in many of the distributors, they just haven't yet brought that reporting and that analysis together. And that aspect really matters. Now, of course, sitting in the seat that I'm sitting now, I would say the most underestimated part of the plumbing is liquidity. It's a feature, not a flaw. Alternatives reward patience and are designed for investors willing to trade that liquidity for potential return enhancement. And getting out early destroys returns and often forces forced sales of underlying assets. And the industry's made some progress on liquidity mechanisms. Evergreen and semi-liquid structures have made entry easier. They're still less liquid. That's just a fundamental fact. And the products in the current form, we believe that an active secondary market, even for retail level involvements, is possible. And in fact, we're building it to access it. It's going to be easier to buy if you know that you'll be able to sell at a price. We're also, though, starting to see interesting product innovation. That blended public-private product that's allowing liquidity, different mechanisms to get the exposure. So I think the market will adapt to clients' needs, but we're not there yet. We're also starting to see a little bit of embedding in DPM, and that's going to help things as well. As you say, we need to see greater standardization, data, terms, timing. This is like the OTC market. It will evolve, but it's going to take time. Maybe a bit of regulation too. A little bit of controversial, but I need to say it.
Let me challenge a popular narrative here. Plenty of people say that private markets will simply become the new core of portfolios, sitting alongside or even displacing parts of listed equities and bonds. Do you buy that?
Diversification and asset allocation will be critical to responsible wealth management. Look, I think the future is more private markets, more blended public-private markets, but it shouldn't be all private markets. What I'm seeing, though, is it's starting to become, at the most sophisticated wealth managers and private banks, an expression of allocation. So we're seeing a twofold metric, and by which I'm equity, debt, real estate, infra, but then liquidity class as a cut across. Both of those are essential. And we are seeing some distributors really trying to display that graphically, analytically. The market is changing on that. Now, of course, we're seeing the market change in terms of asset allocation as well in alternatives. The wealth client is allocating to more alternative asset managers, 30% year on year. Clients are allocating to more managers because they're diversifying into more alternative strategies such as infra, but also they're diversifying across managers. And they're starting to incorporate these strategies in new product wrappers and new investment solutions, fund of funds wrappers, discretionary model portfolios, which is doing a little bit of that analytics for the client. Now that sounds geeky, but those professional model portfolios, they're really interesting. The thing is that people don't talk about, which drives me a little bit crazy, is the missed opportunity for clients. Alternatives are a great asset for a long-term hold, even at the bottom end of the continuum. An insurance saving product, a pension product, where you don't need contingent liquidity. It's incredibly important. So think of alts as it's another engine to the portfolio, but we shouldn't swap out and build an entire engine from alternatives.
So if you had to benchmark the industry on a scale of 0 to 10, where 0 is completely manual, fragmented private markets infrastructure, and 10 is a seamless digital end-to-end ecosystem where distributor can add a private fund, let's say as easily as a mutual fund, Where are we sitting in 2026? And what's the single biggest unlock you think to move us up that scale?
Suvo, ouch. I think we're at 5 or 6. I really do, as an industry.
Okay.
5 or 6 as an industry. We're probably halfway there. And I think it's reflected by our distributors. We've got slightly less than half of our distributors. So, around 350 out of 950 have alternatives on their shelves. For it to be mainstream and truly scaled, everyone needs to do a lot more thinking and a lot more work. So if we go back to that analogy as alts as OTC derivatives, it took quite some time for that asset class to become more consistent, more comparable, transparently priceable, and we're in that cycle with alts. It's still too complex and it's complicated. The systems need to be the same and both issues need to be solved. I think we're 3 to 5 years away from seamless. To answer your question, unlock will be consistency of product design taxonomy, not product design, but product design taxonomy. That's data, transparency, pricing, markets for end clients. But one of the fun things about being Allfunds is to be able to be part of the infrastructure that helps the industry work and to drive the creation of a standard. We are helping it develop to where it needs to be. And there's an ecosystem, and we're a pretty large part of that. So we can really help the industry to simplify and consistify, if that's a word.
Mm-hmm. So one last point on this topic, Annabel, drawing on your years as a banker. How did you think about the role of private markets in building a resilient, scalable wealth business as a banker? And has your view shifted now that you look at the world from a neutral platform standpoint, rather than a bank trying to capture the margins?
Shiva, I'm really clear on this. The core of my philosophy hasn't changed and it won't. Whenever you're in the wealth management ecosystem, value chain, etc., you've got to act in the best interest of the client. If you are playing purely or even majorly for margin, you're not playing for the long term. So I think it's critical to offer the end client diversification. It's better performance over the long term. Diversification means open architecture on product, as no firm is the best at every asset class globally. Now, one thing to remember is we haven't had a downturn for a while. And when things go down, people blame their banks. And if everything is labeled with the bank's name, that is not good for the relationship with the bank, with the client. Now, just a word to the wise from those who have been around for a little while longer. One to watch. So diversification, though, incredibly important, also allows the banks to offer leverage over the portfolio, better for the client in terms of returns, but also better for the bank. What has changed in the way that I see things is the cost of complexity in providing for that diversification and how it can be better managed and outsourced. Again, don't reinvent the wheel. Just outsource it on with the bit of the tech and the infrastructure stack that the clients see and specifically values that relates to your engagement with them, and get on with the product and asset allocation that is right for them. We will make the rest easy for you.
Okay, shifting topics now, Annabel, to technology, specifically AI and data. Now, this is the part everyone claims to be doing, and very few are doing well. When I talk to practitioners behind the slick front ends, many still describe their core operating model as a patchwork of legacy systems, spreadsheets, and manual workarounds. So let me ask you straight. Have we genuinely moved beyond digital front ends into real operating model transformation?
Ooh, you're right. Are we allowed to say that there's a fair bit of AI washing out there?
Of course.
Are we allowed to say that?
Yes, of course.
I think one of the fun parts of my role is talking to distributors and seeing both what they show to clients and then inside what their colleagues use to produce that. And they are quite different. But I'm really excited by some of the platforms I'm seeing, not just the newer fintechs, which are digital and AI native, but some of the scale players' use of AI. And you know very well personally that is excellent, and it's made a really step change in the market in this market for technology. I do believe incumbent firms can get AI right and solve their legacy issues, map their code, understand their interdependencies, modularize their IT architecture, reset their core systems, and be more agile. That will allow them to maximize the value of their data, and they have more data than the newer players. They can provide better personalized insights and customizations. The ones who do that fast will be the players that win. But those that are stymied by their complexity, and I see those as well, they don't get AI right, they are falling behind at a faster rate than before. It's the pace of change that we have the privilege of seeing at some firms, and we're starting to see the separation from those who use it and those who don't. It's not just an efficiency game, it's a client focus game.
Mm-hmm. Now, if you were ruthlessly honest, Annabel, what are one or two use cases where technology has demonstrably changed the economics of wealth management? Generally lower cost to serve, improved risk outcomes, or driven better engagement? And which use cases are still, frankly, mostly PowerPoint?
So many things. But if I were to pick the top three, investment apps have changed the game for retail investors. They've made it more accessible, instant access to their accounts, portfolios, broader financial markets. Now, I think that accessibility can be a double-edged sword. We've all heard stories about that guy sitting on the bus. He saw the market go down. He sold. That might not have been the right answer. But overall, they have dramatically expanded access to wealth creation and improved financial awareness for millions of people. The second thing is choice. The facilitation of choice through open architecture and product, mutual fund, ETFs, has been enabled by technology and it's driven costs down. At Allfunds, we're part of that. The quality, the range, the fee cost to the end client offered has materially improved. The third thing is data analysis and optimization of portfolios. Data-driven analytics and asset allocation, including risk metrics, scenario analysis. That ability to show a client what happened in the last GFC that might happen to their portfolio now, what happened during the Ukrainian war that might happen now, what's happening in various scenarios going forward, including in the Middle East, what might happen, and therefore how they should reposition. That has tremendous value to the end customer and can only be run with digital technology. Those three things would be my top three picks.
Okay, Allfunds increasingly positions itself not just as a transaction pipe, but as a data and analytics hub. You signed a strategic collaboration with MSCI earlier this year to deepen the data and risk analytics on the platform, and you've leaned into blockchain through Allfunds blockchain. You've recently extended tokenized funds onto public networks like Solana. So when you cut through the noise, what are the most realistic and valuable applications of AI and advanced analytics on a B2B platform like yours? Where's the real value that you're seeing?
A lot in that question. So let's take it as two. I'm going to break it into tokenization and AI because I think the stories are quite different. Mm-hmm. Tokenization's been a theme for Allfunds for a while. We've launched tokenized share classes for traditional funds like BNP, evergreens like Hamilton Lane. This model brings private equity and traditional funds to a wider audience across Europe, the Middle East, Latin America, and Asia by enabling end-to-end digital subscriptions, importantly, lower transaction costs and greater transparency. But I was in Paris 2 weeks ago in a series of meetings, and we're starting to see the convergence of the DeFi and TradFi world, tokenization, stablecoin, coordination with crypto. So we've already got, tokenized chain settlement efficiency speed. It's not hype. But now the partnership, the network effect is growing. Very much your ecosystem commentary, actually, which is hence really, I think, our Solana partnership. It enables tokenized funds available on Allfunds now to be accessed seamlessly across both traditional financial infrastructure and on-chain environments. So we're going to start to see that consistent availability wherever investors choose to operate. And I believe that network effect will grow and the pace will be the expectation in the future. It's going to take a little time. It's going to be one of those things that feels slowly at first, but then moves very fast. And those who are not ready will be left behind because that real-time connectivity and that global connectivity really solves for clients' demands. So I think there's a real case for moving at pace in tokenization. AI is an entirely different question. I spent a few days in Oxford last week with 12 other CEOs across a range of industries sharing about AI, candidly what we were doing, what had worked and what hadn't. AI is no longer a thousand flower bloom concept. I think we've passed that stage, right? We now all understand the concepts and the cost of non-targeted use. Quite frankly, Copilot for All just leads to prettier PowerPoints and lots of emails. Some of them are beautifully written, but just lots of emails. So the game changer for us is targeted application. Firstly, to perfect data. AI methodology might change, but our data can be priceless, and we can use AI to do that. Secondly, to speed up coding, make it more flexible, reduce time to market, time to customer delight, time to insight. B2B is all about insight from platform scale data, risk analytics, operational automation. So it's hugely helpful. Third, to truly understand your client, their needs, their behaviors, and prepare for the unexpected, and to help clients prepare for their unexpected. And I think that's a lot of what the private bank and wealth managers need to do right now. And fourthly, simply to become more efficient and focus on bringing real value to the business, enabling us to focus more on the value-added activities by creating more efficient processes. So it's really those are the four game changers that we're seeing as targeted applications.
Annabel, because Money Majlis is always a little provocative, let me ask you this. Do you think the industry is overly fixated on AI as a silver bullet while underinvesting in the boring but critical stuff? Stuff like clean data, robust APIs, and interoperable standards. If you had $100 of tech budget in a wealth firm today, especially after attending an Oxford course, how would you split it between AI and boring plumbing?
Luckily, I find plumbing super interesting, given Allfunds is actually the ultimate wealth management connector, literally linking the pipes. I don't think there's a Commonwealth firm to answer that question for. But AI to a means to an end, that term AI strategy, it's just not a good one. We have a strategy and we use technology, including AI, to achieve it. Mm-hmm. And that's the way that we think about our budget. Now, that does include for us what AI can create that's useful. We're using AI to extract us from contracts. Data is correct. That's a great use. But otherwise, it's only as good as the data and systems used. So I do agree that the real work is getting the foundations right. Good data, connected systems, digitized process, common standards. If we use AI to do it, great. But if there's a better way, we'll do the better way. It doesn't matter as long as the work gets done. The one flip side of that, I would say, is what we call the aggressor and opportunity check. We look at AI competitively. The aggressor check is to see if this business was starting de novo and attacking ourselves, what would we design differently? And then the opportunity check. What super cool thing could we do that would delight our customers? But getting back to Oxford, what we all agreed is that we had 4 responsibilities. The first is to be educated, because our responsibility is as leaders to be educated ourselves and our teams on AI. The second is that AI needs to be risk management governed. The risk of data drift and data exit, it's serious. The third, as you rightly pointed out, it needs to be targeted, cost effective, and highest priority use. And the fourth is that one I talked about, to be both paranoid and opportunistic. What's our AI moat, how to defend it, and then how to really use it. But I believe if it's just let 1,000 flowers bloom, we're abdicating our responsibilities as leaders, and we're putting our organizations at risk and our industry's reputation at risk.
This is a good time for a short commercial break. But before we break, I want to talk about the Money Majlis Giving Initiative. Most profits from this podcast go to 6 charities that we support. I invite you to visit my website, moneymajlis.com, to explore all past episodes of my podcast and to choose a charity where you want to redeem your complimentary $50 gift card that is available to all listeners. My guest today, Annabel Spring, has chosen to donate her $1,000 Money Majlis gift card that I presented her today to Educate Girls. Educate Girls is an India-based non-profit mobilizing communities to enroll and retain out-of-school girls, improve learning outcomes, and close gender gaps in education. Thank you, Annabel. See you after this short commercial break.
Running a business means you have to make countless decisions every single day, some small, some risky, yet all pave the way to your success. That's why you need a seamless business banking app that doesn't just react, it anticipates. From digital account onboarding, effortless fund transfers, smart payroll and utility payments, easy digital service requests, exciting rewards and benefits, and long-term tailored solutions, the Fab Business Banking app gives you everything you might need, anytime, anywhere. The Fab Business Banking app, the one app for you.
In Money Majlis, we talk about making informed money decisions. With Saxo Bank, you get access to global markets from a single advanced trading platform. Stocks, ETFs, Forex, CFDs, commodities, and more. With research and tools right there in the platform, it's easier to make sense of what's moving the markets. Learn more at home.saxo.me.
Money Majlis is brought to you by Network International, the Middle East and Africa's fintech and digital payments champion. We make businesses happen and economies prosper by simplifying commerce and payments. Trusted by over 250 banks, fintechs and telcos, and 240,000 merchants in over 50 countries. We move fintech forward.
The financial world is changing fast. Institutions need to meet the growing client demand for crypto financial services, but they need a battle-tested platform to build upon.
AquaNow is a leading crypto financial services platform, powering incumbent institutions to launch crypto brokerage, payments, and remittance services for their clients, securely and at scale.
Be part of the transformation. Visit aquanow.com today.
Your wealth deserves an approach built for tomorrow. Welcome to WealthBricks Capital Partners Limited, where wealth is structured, preserved, and grown through trust. Our approach is holistic and covers private wealth, asset management, and corporate finance. Your wealth deserves more than legacy. It deserves foresight, clarity, and confidence. WealthBricks Capital Partners Limited, an independent and expert wealth management firm, regulated by the DFSA.
Welcome back. My guest on Money Majlis today is Annabel Spring, Global CEO of Allfunds, the leading global wealth tech and fund distribution platform. Annabel, I want to turn now to partnerships because one of the quiet revolutions in finance has been the shift away from owning every layer of the value chain towards ecosystems of specialists. Why have partnerships become so central to growth strategies in wealth and asset management? Is it speed to market? Is it regulatory complexity? Or is it capital efficiency? Or is it a deeper recognition that no single institution can keep up across product, distribution, data, and technology all at once? What is it?
I think it's all of the above. No single institution can lead across product, distribution, data, and tech at once. And importantly, in wealth management, have a fiduciary offering for the best that is needed for every client. I think this first became really obvious in wealth management with asset management. No firm can have the best in every solution and be the best for their clients. So I think the industry's worked out over time and is increasingly working out that open architecture is the best fiduciary solution, even if it's expressed in sub-advisory form. But we mentioned before that ecosystem and how the client sits in the center. To ensure the ecosystem truly works and delivers for the end client, you need specialists. You need the efficiencies of scale, the effectiveness of scale. So partnership's no longer an option, but a must, particularly as you get into the network effects, which is very much the case with our industry. So fast-paced ecosystem, network effect, evolving towards specialization with real pressure on margins. You've got to pick your battle. You've got to pick your battles and look for partners to unlock others. So there's a real importance of combining transformation in an industry. That's important. The second thing is the network effect, of course. So our partnership with Solana, the tokenization market is so vast that alone it becomes too expensive for us to cover and too extensive for us to cover. So by partnering with Solana, we enable our clients to access investment opportunities that they just weren't accessible before. So that network effect drives adoption and improvement across the industry. So you've got to pick your battles and look for partners to unlock others. So if you look at our partnership with MSCI, one of the things about this industry is we've all known each other for a long time. I've known Henry Fernandez for MSCI from an embarrassingly long time, and I've watched him build that business. And one of the things that they've specialized in is institutional grade ESG data. That's something that I knew we could add our offering to clients, and it's something our clients would appreciate. So there, you pick the best of the best, you partner with them, and then you deliver it to clients. And that brand name didn't hurt either with our clients, when you've getting that institutional grade strength.
You've seen partnerships from inside a giant bank and now from a platform that lives or dies by the quality of its ecosystem. In your experience, what actually makes a partnership work beyond the press release, And conversely, what are the red flags that tell you that a partnership is more branding than substance?
What works best is if everyone's a winner. Both parties and the client, the incentives are aligned day one, and the exit is agreed day one. There's a fundamental bit of communication that needs to happen in a partnership, just like a joint venture. There's that old saying, same bed, different dreams, not going to work for the long term. Recognizing that the partnership will need to evolve with changes in the world and having mechanisms for communication, honesty about what that looks like, almost like a prenup. It's a bit like going into a marriage. You need a prenup. Yep. It's really important before you sign. So there's a word that I really dislike, and it's announceable. If you are rushing to announce versus agreeing what's in it for both parties, what's the benefit for the client, what's the communication methodology, what's the way out, it's not a good idea. And for me, that's fundamental. And sadly, I've spent a lot of time for Morgan Stanley, for CBA, for HSBC, exiting joint ventures and partnerships. The exits that were better and didn't break anything for either partners or for the end client were the exits where there was good communication and the path was agreed.
Now to the big one, Annabel. Last November, Deutsche Börse announced a recommended acquisition of Allfunds, a deal valuing the company at about 5.3 billion euros at a premium north of 30%. Shareholders have approved it, and the plan is to fold Allfunds' distribution strength together with the custody and settlement muscle of Deutsche Börse's Clearstream fund services, with completion expected in the first half of 2027. This is, in a sense, the ultimate partnership, a full combination. So let me ask you the obvious question. Why does this deal make strategic sense?
Suvo, the best strategies are simple. Our complementary footprints and capabilities create together a world-class player. Allfunds and Deutsche Börse have highly complementary businesses in terms of product suites, client bases and segments, strategic distribution partners, and key market serves. So the combination brings together Allfunds' distribution strength, its modern operating platform, an established position in alternatives, which we've talked about, an extensive global footprint with Deutsche Börse's fund execution, custody expertise, robust European ETF franchise, and market infrastructure capabilities. Our growing presence in the Americas, Asia, and the Middle East will serve as a key growth avenue for the combined business, which really complements Deutsche Börse's fund services footprint across key jurisdictions, as well as existing franchises in Asia and Australia. And I'm quite a fan of Australia, as you can imagine. But and I certainly do, as a former head of strategy and M&A for both CBA and Morgan Stanley, what I've learned is that leading through execution is ultimately what makes the difference. Here, the strategic rationale is clear. Communicating that as a compelling vision, preparing people for the journey, and ensuring that employees, clients, and partners really understand the benefits of coming together, that will make sure that we get the best outcome for everyone. It's going to be a lot of listening, especially to end clients, but the strategic sense is absolutely compelling. And that work, I think, will give the combined entity the ability to ensure that we turn what I believe to be a strategic vision into a successful reality. And as you can tell, we're pretty excited about the opportunity.
Amazing. Annabel, I want to take a minute to acknowledge a poignant backdrop. Allfunds founder Juan Alcaraz, who built this company over 25 years and took it public, passed away, unfortunately, earlier this year. You inherited the business he created and are now steering it to a completely new chapter. How do you think about honoring what Juan built while making the bold changes the next phase clearly demands?
Thank you. It's been a really difficult time for the firm. I think Juan's vision was incredible and his passing was just a huge loss for everyone. And when we talked about it as a team, the best way to honor the vision is really to build on it. So to look back 25 years ago, Europe had no equivalent to the US centralized infrastructure for securities transactions. Juan's insight was that an open architecture B2B platform, neutral, scalable, end-to-end, could really rationalize that fragmentation and allow mutual funds to reach distributors and their clients globally with operational coherence. And he created this digital ecosystem that we've just talked about, sitting across the fragmented European post-trade infrastructure, and made integrated fund distribution really work at scale. So what started with Juan's vision 25 years ago in Spain with mutual funds has turned into this global company with over $2 trillion in AUA, mutual funds, now alternatives and ETFs across 66 countries. So we just keep building, and that's a great way to honor his legacy.
Absolutely. Let me shift gear now to challenge the ecosystem orthodoxy more broadly. There's a real risk that partnerships become an excuse not to invest in core capabilities. Where do you draw the hard line and say that this we must own, this we're happy to rent, and this we will genuinely co-create? Looking at Allfunds today, what are some of the non-negotiable capabilities a platform like yours simply must keep in-house?
That takes me back to business school. Okay. Our view when considering our strategies, we want to be in businesses that are global, that are scalable, that have a common contact point with the distribution client from a synergistic perspective. We only want one global sales force, really important across 66 countries, and where we believe that we can be the best in the world. And that's what you need to do to compete in wealth. You really need to be the best across mutual funds, alts, and ETFs. So those are the capabilities that are non-negotiable. Our value comes from that ecosystem, connecting distributors and managers, not competing with them. Understanding our clients' needs, bringing both sides together, creating that ecosystem, that's core to who we are. We need to own the platform that powers those interactions. So we're drawn to and we're driven to build scale, resilience, connectivity, client experience. The data we generate is proprietary and data is increasingly strategic. Those insights created across the platform, we know where the flow, which distributors, which fund managers, which products, etc. They create value for fund managers and distributors. They help them make better decisions. So data is a source of innovation and future growth. So what do we buy in? Elements that our clients would prefer to be in one place. We talked about MSCI ESG data. We buy that in. We buy in Morningstar fund data. It's branded or it's critical to our clients and they just want to make things easy. We buy in capabilities that we have no need to create. If a partner can help us deliver capabilities faster, then collaboration makes sense. The question is whether a capability is critical to our client relationships, our network effect, or our long-term differentiation. If it is, we want to own it. If it's not, we'll partner and co-create.
Mm-hmm. Let's zoom out now, Annabel, to the future of global wealth. The forecasts point to continued growth worldwide with the strongest momentum in Asia and the Middle East, exactly where banks like HSBC and Emirates NBD have been doubling down. Layer on top of that, demographic shifts, the largest intergenerational wealth transfer in history that you talked about earlier, and a cohort of digital native investors with completely different expectations. When you look out 10 to 15 years, where do you see the most significant sources of growth? Geography, new client segments, or product innovation?
Huge question. Super exciting future ahead of all of us. So maybe a crisp answer. Growth is global, as you say, cross-border for wealth in a way that has never been. So Middle East, Asia, LATAM, please don't forget Africa. And the Middle East is increasingly a pushing off point for Africa, and particularly in wealth. Some really interesting things going on there from the Middle East as well. Second theme, wealth is getting more knowledgeable and sophisticated. And so the product shift that goes along with that is very important. Thirdly, on your advice question, people are still people and they need to talk to people to feel and be understood. There'll always be a thing that maybe, and maybe this is just private banking, but that they don't want to write down. They just want to have a conversation about. They just want to think about with someone. And with respect to advice, I always say you get what you pay for. If you aren't paying, then you or your personal data are the product that's being sold. Important to remember. And as long as people remember that and regulation makes sure that they understand it, we'll be in a good place as an industry. Fourth theme, tech drives pace, customization, and flexibility in a way it never has before. Tokenization and blockchain will make it a T world, not even T plus zero, just T. Mm-hmm. And it will increase the range of access to asset classes. New products are inevitable, they're exciting. Crypto of different coin, Bitcoin, tokenized gold, real estate, everything. What changes most, though, out of all of that? Expectations. Institutional quality access with consumer level engagement, simplicity at pace, and absolute customization.
Mm-hmm. Now, let's picture a wealth client in 2035. Will their day-to-day experience look radically different from today? Or will most of the change be in the invisible infrastructure beneath the surface? In your mind, what are one or two parts of the client journey you are most convinced will be transformed? And what do you think will stubbornly remain the same?
Big questions. I think what will be completely transformed is pace. This blending of TradFi and DeFi, tokenization, stablecoins, state-sponsored, we'll be able to see money moving at a pace through the world with much less friction. However, you asked me the end customer, most of that transformation will happen below the waterline, data, infrastructure, automation, connectivity. The best technology, I think, is invisible. But I think the customers of tomorrow will just expect speed and seamlessness in a way we can't. But what is certain and won't change is the thing that hasn't changed forever. What is certain is death and taxes. Mm-hmm. That might seem a bit depressing. But for wealth management, that is the need to protect insurance will always be there. The need to grow wealth management, and that complexity is introduced by taxes. And that changes structures and products across border. And one thing for sure, borders are also not going away. So people will need to grow their wealth. They'll need to protect themselves and their families for future generations. Those needs are critical to the wealth management industry, and they will stay stubbornly the same. And we will need to serve them. So there's a future and hope for us all.
Mm-hmm. Now, we tend to talk about wealth as one monolithic thing, but in reality, it's private banking, it's mass affluent, retail banking, institutional, family offices, external asset managers. Now, do those traditional segments still make sense a decade from now, or do the boundaries blur, you think?
So after more than 15 years running global wealth management businesses, can I tell you my dream? Mm-hmm. My dream is one set of tech and infrastructure, products, solutions, and research, one CIO view that supports multiple markets in a full wealth continuum in an omni-channel proactive way, completely data analytically intelligent, that supports direct, advised, and both. That has a low cost to serve and simple products at one end, and MFO delegated authorities and complex and sophisticated solutions at the other. That's the dream. The segments do have different needs, and clients move up and down them. And I think that often gets lost. They move up and down, and they keep elements of their products on each end, and they want elements of each. So I think the blurring of the segments is inevitable. But all clients are becoming more sophisticated. The industry to customize is growing. We need to get to a seamless continuum and a seamless infrastructure. And that is the demand of our end client. And therefore, that's what really the industry should be focusing on. And sitting now at the infrastructure layer, we're really providing the support for those banks' offerings. But that's what private banks and wealth businesses and fintechs and wealth techs, that's the engagement layer that they need to be building, recognizing that that continuum is blurred, it's up and down, and you're going to have people who want products from both ends of the spectrum for all sorts of different reasons.
So here's a Middle East question I have to ask, given where I am. The Gulf has gone from being a place where wealth passed through to a place where wealth increasingly lives. Family offices relocating, sovereign capital deepening, a fast-growing affluent population, and a lot of wealth firms, coming in to town. I am myself a co-founder of a wealth advisory firm called WealthBricks, based in Dubai. From a platform's vantage point that you have, how do you see this region's, Middle East's role in global wealth distribution evolving over the next decade? And what does Allfunds' presence here, with an office in Dubai, allow you to do that you couldn't do from London or Madrid?
It's funny. I've been coming to the Middle East probably for a very long time, and it's changed so dramatically. I remember when I first came to Dubai, you could drive anywhere in 10 minutes. Do you remember that?
Yep.
Anywhere in 10 minutes. Then it was 15, then it was 20, and then it was check the traffic. It could be bad. So, I think that the Middle East has really changed dramatically. And it's rising to the top tier of global financial centers. And we at Allfunds, we see more of that money coming onshore and staying onshore. We've been part of that journey now for more than 15 years, and we expect further growth and opportunities. But I think that the relationships of the Middle East are changing as well. It's that gateway now between East and West, easy access to the GCC, India, into Africa. The link to Singapore has always been there. Switzerland's always been. We saw that at HSBC, and we see those flows now at Allfunds as well. The prominence of the Middle East in wealth has fundamentally shifted, and it's shifting, continuing to shift, and I think it'll continue to grow. The thing that I love about the Middle East personally is the embracing of the tech boom. The responsiveness of the region to adapt to and adopt technology and digital solutions, and also to adapt and adopt to new products. There are some very high-tech banks. There are some very sophisticated retail platforms, and that's a joy to deal with. And I think that's something that the Middle East is increasingly leveraging with its relationship with the asset managers around the world. Now, we are a global local organization, so there are specific needs. We adapt locally Allfunds platform solution. We have obviously an extensive range of Sharia funds and ETFs, which when added to the conventional range, gives a solid foundation for any entity looking to create a wealth management business in the region. But it's more than that. And we've always need to remember it's more than that for the peculiarities and choices of every region. So for the Middle East office, we have a local fund solution, which really further enhances our commitment to the region, and it provides asset managers an option to partner with Allfunds to create their local funds. And what that does is provide an increasing range of options for players on the ground and for distribution players on the ground, because they're going to see a wider range of funds. But from the end investment perspective, what are we seeing? Fragmentation is shaping private market access in the wealth segment. We see that allocation frameworks, preferred legal structures, they vary significantly still within regions of the Middle East and client types. We're still seeing private banks in the UAE and Switzerland allocate a lot more to interesting feature of the Middle East. The Middle East was early in Switzerland. The component of the client base that was in Switzerland was early to alternatives. And now we're seeing that go back to the Middle East. And we're seeing a very sophisticated market in the Middle East. I think that's really exciting for alternatives and really exciting for access from the Middle East. It's the only region where clients have more than 10% of their portfolio invested in alternatives. 10%, much higher than any other region. And that exposure remains dominated by private credit. But like I said, it's shifting into infra, it's shifting into private equity. And this year, the share of flows going into infra and private equity is increasing tenfold in the Middle East, reflecting the sophistication of analysis and really that trend of diversification. Incredibly interesting.
Amazing. Annabel, I want to close the main conversation with leadership, because your path is unusually varied. Investment banking and strategy at Morgan Stanley, wealth leadership at Commonwealth Bank of Australia, then global private banking and wealth at HSBC, and now CEO of a listed platform in the middle of a transformational deal. Looking back, Annabel, what have been some of the most important inflection points that shaped how you lead today? Were there particular crises or pivots that forced you to think, to rethink your style?
The thing that's constant for me is curiosity. It's about markets, about businesses, and more than anything else, about people. New York, Hong Kong, Sydney, London, Madrid. I think the real privilege of these roles is how many different people you meet and get to know. And wealth is not a transactional business. It's a personal business with relationships around the world. But you asked me about moments that changed my style. I think that the biggest one was moving from Wall Street investment banking at Morgan Stanley to Main Street retail banking at Commonwealth in Sydney.
Mm-hmm.
That was a huge shift. I had grown up in a direct commercial culture where financial incentives were the drive, and it was perfect just to say, just get it done, will you? Just get it done. And I moved to a culture where personal style and management mattered, and discretionary effort came from management style. It's such a big shift, and one that's been really meaningful for me. So balancing the clarity of the fact it needs to get done with personal warmth, it's so important. And it probably correlated more to my personal style anyway. But what I learned was managing yourself is the key to managing and leading others. But there have been some growing up moments where you feel the responsibility most acutely. Tough times, the financial crisis at Morgan Stanley, the remediation of legacy issues at CBA. There are moments in financial services where you understand so heavily the responsibilities that the financial services system has. People's life saving, they're a huge responsibility, the safety of the financial markets. I think practitioners realize it's not just a job, it's a fiduciary responsibility. And that changes the way you think about risk. And for me, those were big moments of learning and crystallization. There's also learning to lead as you get more senior. Moving from a small team to thousands, that was a big shock. You have to learn the difference between delegation and empowerment. And I can give you an example. When you delegate to a small team, you can say, hey, please do this. You delegate to someone less senior and then you help with them with it. And that's all fine. But that's not empowerment. In a large team, you have to go slow to go fast. So being clear on the strategy, making sure everyone's aligned. And that really aids empowerment. They need to know the direction. Otherwise, they can go off thinking that they know what they're doing, and not a good thing. Ends up somewhere entirely. So understanding the why of the travel so they can make their choices in an aligned way. The second thing you have to do is to ensure the development of managers and teams, making them feel more confident so they feel in control and capable of what they need to deliver. I spend a lot more time developing people and clarifying strategy. We do a lot more training on AI that we've talked about, or LinkedIn, or all these different things, and clarifying the strategy than we do I spend now actually executing. The leaders that I admire now have changed. They absorb pressure, they transmit clarity, and they build confidence in others so they can achieve success together. I think the nature of leadership has really changed in my mind.
Mm-hmm. Now, your time at HSBC, Annabel, coincided with the bank leaning hard into wealth as a core strategic pillar, especially across Asia and the Middle East, while simultaneously restructuring the whole group around 4 businesses. What did you learn from running a global wealth franchise inside a systematically important bank like HSBC that you now bring to running a more focused, platform-centric business like Allfunds?
There were some big lessons. I think the first is be clear on the strategy and the priorities, and then communicate them endlessly and consistently, almost to and actually past the point of boredom. And you can imagine HSBC, it's the ultimate matrix. You've got countries and business areas, legal entities, it's so matrix. You need buy-in from the top, the sides, the other business units, everywhere else, as well as actually, those external clients. In a big bank, wealth flows in from the business bank, it flows in from the retail bank, product comes in from the institutional business, the asset management business, the insurance business. And then you need to be open architecture, because you actually need to make sure that your end clients are getting the absolute best. And then every country wants to have the investment. Every country wants to have the best app, the best everything. The matrix of all of that is tricky. And the best way to manage is to be super clear on the strategy. It's super clear on the prioritization. But what did I learn? I learned I really needed to spend time in every country explaining it. So when I talk about Dubai, I spend a lot of time in Dubai, Abu Dhabi, Kuwait, Qatar, Saudi, just sitting down with people, really, really conveying what we were trying to do and being consistent. The second thing, though, is people. Get great talent. I am super proud of the team we built who are delivering still so well. I'm a huge fan of HSBC, and shout out to all of the guys in the Middle East. They're both creative and expert. For HSBC, we wanted to move higher into ultra high net worth, better into digital, and rebrand our franchise as a wealth franchise. So we needed to add all of the expertise to do that. And we need to make sure that we had the best help. We didn't have a lot of funding. So getting back to my theme that wealth is about relationships, try to think about like what would be the best way to rebrand our franchise to a wealth franchise. So I called BlackRock and I asked Larry Fink, who I had known from Morgan Stanley, could he do me a favor and be interviewed? So I interviewed Larry Fink and we sent that out to our customer base. We put that on our website and it really showed in a sort of shaking up the market kind of way, just how serious we were about wealth. And remembering this is like 6 or 7 years ago, where HSBC was just starting this journey. And it also set a great precedent because after Larry Fink wanted to do it, well, every single asset manager, CEO was prepared to sit down and be interviewed, which meant we got absolutely everybody, which was fantastic for our client base and fantastic for that. So people's not just about the people you hire, it's about the relationships you have. Now, underneath that, 2 quick things, but not quick to do. Tech and data architecture really matters. It's the foundation of operational excellence and client satisfaction, even more relevant in the age of AI, critical for the wealth tech and fintech that now I'm responsible for. And finally, global local listening. You need to be global, you need to be local. You know, the simple thing is that credit card, it might work in the UK, but if the rewards are not relevant in Dubai, it doesn't matter if it can get you the opera in London. If it doesn't get you absolutely what's essential in Dubai or Saudi, nobody wants that credit card. So ask, listen, think. That can't be more true at Allfunds. It's a strength of the model. Global, local, hugely important. But those were some pretty big lessons. But it was a tremendously enjoyable time. 30% growth rate, revenue and income for 5 years. Couldn't be more proud of the team, and it's great to see it keep on going.
Amazing. Annabel, you led across very different regulatory and cultural contexts. Australia, Europe, Asia, all global roles run out of major financial centers. Has that global exposure changed your view of what good leadership actually looks like in financial services? Are there things about governance or culture in, say, Australian or Asian finance that you would wish were more common in Europe or the other way around?
I think what's completely consistent and needs to be completely consistent in financial services is integrity. And in different countries, that might be expressed loudly or quietly, depending on the country, but integrity always matters. And in these rather more complex geopolitical times, I think people around the world actually have more in common than it appears. There's a commonality about what people want and need in every market in terms of leadership and management, certainly, and the issues we're trying to solve, looking after themselves, looking after their families. Maybe the solutions are a little bit different, but the needs are pretty similar. I guess I have to admit, I just enjoy the different cultures, and I see that as part of the charm and part of the challenge.
And finally, Annabel, on a personal level, how has your own definition of success evolved over 3 decades? I mean, if you compare the young Annabel Spring at Morgan Stanley with how you think about your role and your impact today, what has changed most in what you actually value?
If you'd asked me when I was an analyst at Morgan Stanley and my first deal was the takeout of KKR from RJR Nabisco, swapping into Borden, success would have been being the best investment banker in the world or the best capital markets professional. I now think that's probably a little bit narrow. Moving to strategy, even at Morgan Stanley before CBA, made me realize just how much wider and more dynamic the world is and how fascinating change can be. And that's guided the rest of my career, that curiosity, learning about industries, working with people to develop strategies, implementing them with every lever. And I've learned to love technology, transforming and growing businesses. So transformation is the fun bit. But what do I actually value? I think it's the impact of transformation. Yes, it's great to grow businesses at 30% cater. I love that. Or make fundamental change for the better. But I think what I value is two things. And the first is power of curiosity and its role in ideas and strategy and execution and transformation and making things better. It's about that curiosity. And the second is development of people and relationships. I'm super proud of my teams. The ones I've been a member of, the ones I've led, their development. You know, the first analyst I hired is now an MD. I love that for him. I love it. I had caught up with him for a coffee in New York a couple of weeks ago. It was just great to see him. That ecosystem of relationships around the world, colleagues that have turned into friends, it makes a huge difference to your effectiveness as a leader. That's the formal thing. But for me, just as importantly, it makes these roles in life fun.
Excellent. Annabel, we finish every episode of Money Majlis with a rapid fire round. Short questions, instinctive answers, and no overthinking. So you get 5 seconds to think and 10 seconds to answer the following 10 questions. Can I start?
Okay.
One financial services buzzword you will happily retire tomorrow.
Semi-liquid alternatives. We should just call them evergreens. That's what they are.
Okay, a book, a podcast, or a thinker that has genuinely shaped how you make decisions.
2, Daniel Kahneman's Thinking Fast and Slow, making sure you're using the rational brain, not the reflexive one.
Yep.
But right now, I'm reading Sebastian Malby's Infinity Machine, and it is fascinating.
I should pick that up. The best piece of career advice you got early that turned out to be right.
Don't frown when you're listening. Someone to open up. You've got to show them you're thinking about what you're saying, but your face has got to look receptive.
A piece of advice you ignored and you are glad you did.
There have been so many don'ts. Don't go to business school. You'll never get the time back. Don't have kids right now. Your career's taking off. Don't change from a P&L role to a strategy. You won't be able to show your value. Don't change countries. You'll lose all your connections. My advice would be do take the risk. Your career's a jungle gym. Do move around. Take the interesting job and do have some fun.
Okay. One habit that keeps you clear-headed when you're making a big strategic call.
I worked with a former, I think he was a lieutenant colonel, and I was obsessing about a decision. I was under a lot of pressure to make. And he said, do you have to make that decision tonight? And it changed the way that I make decisions. And he was even more right now that I've read the neuroscience.
Mm-hmm. If you hadn't got into finance and strategy, what career could you generally see yourself enjoying?
Science. I am in scientific research. I'm on the council at Imperial College in London, which is the number 2 university in the world, tied with Stanford. The rankings just came out. Mm-hmm. And their motto is science for humanity. And there's just so much great research there. I love it.
Your favorite city for thinking, not for meetings, but for stepping back and getting perspective?
Sydney. At the end of the day, it's home. It's got the most beautiful beaches in the world.
I agree with that. Technology trend outside of wealth and banking that you're fascinated by right now?
The search for the next antibiotic. At Imperial and the Fleming Centre, our researchers are using AI to develop antimicrobial peptides that can kill drug-resistant bacteria in new ways. That is one of the greatest threats to humanity's future. I think it's phenomenal.
One thing about the wealth industry you wish more end clients understood?
Can I have 2? Mm-hmm. Diversification and time in the market beats timing the market.
And to end on a lighter note, Annabel, a guilty pleasure your colleagues would be surprised to learn that you enjoy.
Chocolate and ocean swimming. It's lucky they both offset each other, or at least I hope.
Annabel, this has been a fascinating conversation. We've traveled from the deep plumbing of wealth distribution, the realities of private markets, through the promise and limits of AI, into the logic of the Deutsche-Bosch combination, and finally into what it actually takes to lead large, complex organizations through structural change. Thank you. Thank you for sharing both the Allfunds vantage point and the hard-won lessons from your earlier roles at HSBC and CBA and Morgan Stanley. Any last comments?
Thank you so much for the opportunity to reflect and also to look forward. I feel like the future is coming faster and faster, and it's been such a pleasure speaking with you.
Thank you.
Fab Business Banking presents Money Majlis, a podcast shaping conversations on banking, finance, technology, and marketing. Visit bankfab.com to learn more.
Money Majlis is brought to you by Saxo Bank, the trusted European bank helping you make better investment decisions.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Now, the premier crypto-as-a-service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
Money Majlis is proudly sponsored by WealthBricks Capital Partners Limited, the trusted, independent, and expert wealth management firm.
If you enjoyed this episode, follow Money Majlis, leave a rating, and share it with someone in your network who cares about the future of wealth and investing. And do remember to visit my website, moneymajlis.com, to join my giving movement. I'm Suvo. This is Money Majlis. Thanks for listening, and I'll see you next time. Till then, stay well, stay curious, and do good.